All right. We are now in chapter 9. And for some of us, that doesn't really mean we're in chapter 9. I am currently moving different textbooks, same author, same general textbook, but the chapters are all, as you've probably already noticed, the chapters are all mixed up. Halfway through recording these lectures, I decided to update to a different book, and I'm currently in the process of doing that. So you will notice the difference, or like I said, you've already noticed the difference. So we're not really in chapter 9, we're in chapter whatever. It's probably like 16 or 17, maybe 8, 19, 20. I have no fucking idea. But it's the same concepts. All the PowerPoint slides are basically the same. The only difference is that it's not chapter 9, it's chapter something else. Okay, so the bigger point in this chapter, we're going to cover performance measurements and responsibility accounting. And the main idea is that we are decentralizing our business, okay? If we're a landscaper and we're a really small company, a lot of this chapter doesn't make a whole lot of sense. But as we grow as an organization, we need to empower our employees to make decisions for us. That way we can effectively compete in the marketplace. We can't have the CEO making all of the decisions about everything in the business. Instead, we have to get vice presidents, production managers, sales managers, all sorts of different individuals within the organization. And then it comes time to how do we measure the performance of those individuals? Okay. So that's what this chapter is about. Um, Going through the table of contents, the table of contents in this book are fucking like I have no idea how they work. That's so confusing. But what we're going to do, we have conceptual issues that we're going to talk about. So we're going to talk about transfer pricing, but that's not till the very end of the chapter. So I don't really know why it's the first thing listed in the objectives. We're going to allocate costs across products. We're probably going to spend a little bit of time on that, not too much. We're going to analyze investment centers, and we're going to talk about what an investment center is. We're going to use various methods. One, residual income. Then we can use investment turnover. We could use a balanced scorecard. And then we can use cash conversion cycles. All those are different aspects or ways that we can analyze an investment center. We're going to then talk about preparing a responsibility accounting report using controllable costs. And that's what I'm going to do actually in this lecture. Then we'll talk about indirect expenses related to the department and then department income statements and so forth. So anyway, again, it all has to do with the backdrop of decentralizing decisions. Okay. So first learning objective, prepare a responsibility accounting report using controllable costs. Okay. So before we even go into that, the first thing that we're going to do, um, like always, hold up. Okay, I think I got my pen working. And I think I finally figured something out. There is a difference between, well, maybe you can't even see these, probably can't. But these pens and the pens that are in draw, it's the draw that I want to be using. No, nothing like figuring it out 25 chapters into these lectures. Come on, Steve. All right. Anyway, the first thing that we're going to do is we are going to create different types of centers within our organization, okay? And here are the first three major centers, all right? So we have a cost center, and then we have a profit center, and then we have an investment center. So first, a cost center, we're going to evaluate on the success of controlling actual versus budgeted costs, right? So if I think about like what is a cost center and within an organization, I can think of a hotel, and maybe you can think about the Marriott hotel. I live in the Bay Area, so it could be the Marriott Hotel here in San Francisco. And now the cost center, it's a function of the hotel that doesn't have anything to do with generating revenue. It's just the functions related to costs. And so the first one that comes to mind is probably housekeeping. Okay. There's a manager responsible for making sure all the guest rooms are clean, either when the guests check out or before they check in. And then even while they're staying, they're maintained, right? So housekeeping doesn't have anything to do with the reservation system or the price per night. The manager really is only responsible for making sure that the rooms are clean and they're cleaned the right way, and only activities that occur within that department are things that generate costs. So we would call that a cost center. And the manager would be measured on how well he or she manages the costs relative to the expectations, right? So if maybe we're gonna be assuming that we'll spend $20,000 on linens, right? That's the budget. And then if we end up spending $25,000 on linens, there is a difference in $5,000 cost. And so we would try to evaluate, or we would try to figure out what's the reason behind the increased costs, et cetera, et cetera. Then you have what we would call a profit center. And a profit center, if we're sticking with the same hotel, right? Uh, we would have a situation where the profit center would be responsible for both the revenues and the costs associated with the hotel, right? So it would be for the Marriott in San Francisco, it would be the general manager would probably be responsible for the entire hotel, right? And that general manager would be measured on the income that that particular hotel generates. And I'm just going to say that there probably is a fourth entity that we would want to talk about, but we would have a revenue center, right? So not only do we have cost centers, but we will have revenue centers. And again, thinking about a hotel, the reservation system could be a revenue center. It's solely responsible for generating the revenue of the business. In a hotel, that's a really complicated thing because prices are different on Monday through Friday as opposed to Saturday and Sunday. A lot of us think that hotel prices are probably more expensive on Saturdays and Sundays, but that's because we mostly travel to leisure destinations. But if you think about, work locations or hotels that are near convention centers, it's probably the case that the revenue or the per night rate is more expensive during the week because more demand occurs during the week for individuals coming into town to the convention center. So it's complicated. And then, here in San Francisco, it's clearly the seasons are different, right? So during the summer, it's very cold in San Francisco, but in August, September, October, it's actually really nice. And so the rate that you would pay on a Saturday night in June is probably much different than the rate that you would pay on a Saturday night in September because the weather is much nicer in September and therefore there's more demand in September. So there could be revenue centers in addition to just cost centers. And then profit centers were what we were just talking about. And then finally, we have an investment center. Okay. And an investment center, it's going to evaluate the way the manager uses the assets. And I tend to think about cost, profit, and investment centers in the context of hotels. So an investment center for a hotel could be the brand Marriott, right? So you have the hotel, the Marriott Hotel in San Francisco. I'm sure you have a Marriott Hotel in San Diego. You have one in Los Angeles, probably many. And there's one particular manager who is responsible for all of those different Marriott branded hotels. That to me is the investment center. And then each specific hotel is a profit center. within any particular division, you have what we call controllable costs as opposed to uncontrollable costs, right? So there are some costs that the manager has no control over. And a perfect example could be if you are the manager for a particular, like if you're responsible for the housekeeping at a hotel and you are looking at your salary for the year, you don't really have any control. I mean, obviously, you could say that you don't want to be paid, but that's not really control. You're not the individual setting the amount of pay that you will earn. Somebody else is deciding that. And therefore, we're saying that the manager of the housekeeping department doesn't really have any control over that particular cost. Instead, the manager does have control over the cost of linens, right? So there are things within the department, costs within the department that are controllable and some costs that are uncontrollable. And if we're being measured on our performance, then we're going to say, hey, listen, I want to make sure that we only measure my ability to manage this department based on the costs that I can control, right? We shouldn't I shouldn't be responsible for like not hitting a budget if there are uncontrollable costs in there that lead to higher costs than anticipated. Okay. This this particular slide, I guess, is basically just telling us there are, if you think about the beverage department of a particular company, there are particular costs within a beverage department, and the manager of the beverage department is going to be responsible for those costs. But then the plant manager, right, one level above, is also going to be responsible for those costs. The plant manager is going to be responsible for the beverages, and then it'll be responsible for the food and maybe even the service department. Okay. Then it could be the case that there is an executive vice president who's responsible for all of the operations in the United States, or at least within the western area and the eastern areas of the United States. Okay. So when we're talking about the cost of, I don't know, water that goes into our beverage, there's going to be different levels of responsibility for that particular cost. That's all this schedule is showing. And then this is the same concept. However, it's simply the costs, right? So down the lowest level, the beverage department. The beverage department has got a bunch of controllable costs that total $79,600. And look, it's direct material, direct labor, utilities, things that are necessary for producing beverages. But then all of those costs, right, as the graph is showing, lead into the plant manager's Western facilities. So the plant manager is obviously going to be responsible for everything that happens in the beverage department, but then the plant manager has all sorts of additional costs to be measured by. And then all of those costs, again, roll into the vice president.